It's a red shirt today. It's a mustache, and you know what the combination of those two things means. We're talking capital gains and capital losses again here, and we're going to get into it right now. What are we talking about today? When does tax loss harvesting make sense, and when does it not make sense? That's a critical decision, right? You can save a lot of taxes by doing it right, but there's absolutely no reason you should be doing it if it's ultimately going to lose you money, and let me show you what I mean. Now here's our example, a nice simple round number so we can all understand. We're going to go with an example where we have a realized capital gain of $10,000, meaning we've sold an asset, we've made that money, we're going to get taxed $10,000 as a capital gain this year for our taxes. Within our portfolio that we haven't sold, we also have a big fat loser stock that has us $10,000 down. Boo to you. But we need to be understanding how this works from a tax perspective when it's going to make sense to activate it as a tax loss. Now, when does it make sense? The answer for that one really is pretty simple. If you have an asset that's lost value and you do not expect it to recover that value in any meaningful capacity, it makes sense for you to sell it, put that cash elsewhere, and perhaps take a tax asset where you can offset some of these capital losses or capital gains. Now, on the flip side, when is it not going to make sense? Well, what if we have that same realized capital gain of $10,000, but now we're going to get our LL Cool J stock in there. Don't call it a comeback. This thing's recouped $12,000. It's now up $2,000 as a gain. And this illustrates exactly what I'm talking about. If we assume a capital gains rate of 15% for simplicity, that $10,000 loss would save you about $1,500 in taxes. If that tax asset, that loss you were going to use, is actually going to regain $12,000 of its value, or anything really over $1,500, this decision may not make any sense financially for you, and that's where you need to be tuned in. A tax loss makes no sense to you if it's ultimately going to net you less money, and that's where a lot of people can get misunderstood on how these things need to be working and what ultimately is going to benefit them. At the end of the day, tax loss harvesting is largely a result of deciding an investment won't recover its value and using its tax impact as a secondary financial tool. Again, if you thought it was going to recover its value, this wouldn't be a decision. You'd want to let it hold it in that portfolio, let it gain its value back, perhaps sell it down the line where you actually make money, perhaps pay more taxes on it because you're smart financially. You know you're ultimately netting more money in that transaction. But if you think it may not recover, if there's reasons to be assessing that, that's where it comes in handy to have a nice tax plan you're confident in, have somebody you can reach out to and perhaps talk about these things on a recurring basis if it's something you're dealing with on a recurring basis. Make sure your head's in the right spot on those things and just make sure you understand, again, the net impact of these decisions. You want to make sure you're always coming out on top on these things.